Welcome to Finance Frontier, part of the Finance Frontier AI series. This is where we break down the forces shaping global markets, trade wars, economic power shifts, and financial strategies that move the world. Whether it's billion-dollar mergers or the next great economic transformation, we analyze how money, policy, and technology collide.
What if I told you the biggest economic power struggle of the decade is happening right now? President Trump's latest tariffs just went live, shaking up markets, supply chains, and trade agreements across the globe. Is this the start of a bold economic realignment or a high-stakes gamble that could push the U.S. into recession? I'm Max Vanguard, bold, fast, and built to decode high-stakes financial shifts.
And I'm Sophia Sterling, data-driven, strategic, and always 3 steps ahead.
Together, we break down the biggest financial and tech trends shaping the future. Today, we're coming to you from the Laredo-Columbia Solidarity Bridge in Texas, one of the busiest trade crossings in the world. Every day, over $800 million in goods flow between the U.S. and Mexico. But today, things are moving a little slower. Long-haul trucks carrying auto parts, electronics, and raw materials are backed up, waiting for clearance. The reason? President Trump's new 25% tariff on Mexican and Canadian imports and 10% on China just took effect.
This bridge is more than just a border crossing. It's a symbol of North America's economic interdependence. Factories in Mexico supply components to Detroit, while Texas oil fuels industries across Latin America. But now, tariffs are disrupting supply chains, pushing up costs, and forcing companies to rethink their entire business models. The question is, who actually wins and who loses in this trade war?
If you stand here long enough, you start to realize just how fragile global trade really is. A single policy shift, like these new tariffs, can send shockwaves through financial markets. Investors are already reacting. Energy and defense stocks are up, tech is down, and Bitcoin, it's in free fall, dropping 18% in just days. But is this temporary market noise or the start of a larger global power shift?
That's exactly what we're breaking down today. We'll explore the real financial impact, from inflation risks to the sectors hit hardest. Are we about to see a global recession triggered by tariffs? Or will these policies force manufacturing back to the U.S., making America stronger in the long run?
We'll also examine how other nations are fighting back. Will Mexico and Canada retaliate? Will China pull a currency devaluation to undercut tariffs? And what about the BRICS nations? Will they use this opportunity to push de-dollarization and shift global trade away from the U.S.?
It's not just about money, it's about geopolitical power. Is President Trump's America First trade policy a stroke of genius, or will it isolate the U.S. from its biggest trading partners?
And then there's the biggest question. Who actually benefits? Will Wall Street, industrial giants, and American steelmakers cash in while tech and retail get crushed? Or will tariffs backfire, driving higher prices, economic instability, and potential recession?
There's a lot to cover, and trust me, this debate is going to get heated.
Before we dive in, make sure to subscribe on Apple Podcasts and Spotify. And if you like what you hear, share this episode with a friend.
All right, let's get into it.
The moment these tariffs hit, markets reacted instantly. Investors panicked, corporations scrambled, and global leaders fired back. This isn't just a policy tweak, it's an economic shockwave.
Max, the numbers don't lie. The VIX just spiked to 23, signaling a surge in market fear. The Buffett indicator is still over 200%, flashing warning signs of overvaluation. And bond yields? Still inverted. That's historically a signal for recession. Investors aren't seeing strategy, Max. They're seeing risk.
Sophia, let's put this in perspective. The Nasdaq has dropped nearly 10% since the announcement. Bitcoin? We're down 18% in days. This isn't just speculation. This is a real-time reaction to uncertainty. Investors are rotating out of risk-heavy sectors and into cash, commodities, and defensive plays.
That's because these tariffs don't just hit corporations, they hit consumers. Walmart's CEO just warned that these tariffs will lead to higher prices on everything. We're talking electronics, clothes, groceries, everything. The moment companies start passing these costs to consumers, inflation spikes. And if that happens, the Federal Reserve might be forced to hold off on rate cuts.
Or maybe this is exactly what the economy needs. Think about it. American companies have relied on cheap imports for years. What happens when they have to invest in local production? Sure, there's short-term pain, but long-term, we get a stronger domestic manufacturing base, more jobs, and less reliance on volatile global markets.
That's a nice theory, Max. But let's talk real-world impact. A 10% tariff on China and 25% on Mexico and Canada means that industries relying on cross-border supply chains are suddenly seeing their costs skyrocket. That doesn't just force price hikes, it disrupts entire production cycles. And it's not just the US responding, trading partners are striking back.
And that's where things get interesting. China just hit Canada with 100% tariffs on rapeseed exports. The EU is weighing retaliatory tariffs on U.S. goods like Levi's jeans, bourbon, and Harley-Davidsons. And BRICS, they're accelerating de-dollarization, setting up more trade deals that cut the U.S. dollar out entirely.
Exactly. This could spiral into something much bigger. If countries start ditching US trade altogether, we're not just looking at inflation and supply chain chaos. We're looking at a new world order in trade. China, Russia, India, and Brazil have been laying the groundwork to bypass the US dollar. If these tariffs push them further in that direction, we could see a permanent shift in economic power.
Sophia, every economic shift looks like chaos at first. The question isn't whether there's uncertainty, it's who takes advantage of it. Industrialists, commodity traders, and investors who see where the power is shifting are already positioning themselves. The real losers? The ones who sit on the sidelines.
And the biggest losers might be the American middle class. If this trade war escalates, they'll be the ones paying more at the checkout, dealing with layoffs, and facing higher interest rates. This isn't just a market story, it's a political story, an economic story, and a global power struggle.
And that's why we're here, to break it down, call it like it is, and figure out who's really winning this game. Markets are picking sides. Some industries are taking massive hits, while others are seeing a surge of new investments. It's not random, it's tariffs. With a 20% tariff on Chinese imports and 25% on Mexico and Canada, sectors reliant on global supply chains are tanking, while those positioned for domestic protectionism are thriving.
Max, investors react instantly to uncertainty. That's why we've seen a sharp drop in tech stocks. Companies that rely on China for production, like chip makers, EV manufacturers, and consumer electronics firms, are getting hit first. The moment investors realize these companies might face higher production costs or supply delays, they start selling off. This isn't even about real losses yet. It's about pricing and future risks.
And that's why other sectors are rallying. Industrials, energy, and defense are seeing huge inflows of investment. Steel producers and U.S. manufacturing firms are benefiting because tariffs make domestic production more competitive. Investors are rotating out of high-growth stocks and into hard assets and domestic production plays.
That's not the full picture. Max retailers and automakers are already issuing warnings. Companies like Walmart and Best Buy are bracing for higher import costs, and Ford and GM are warning that higher raw material prices will squeeze their profits. Auto manufacturing is a cross-border supply chain industry. Higher tariffs mean higher costs, which means either price hikes or profit cuts. Neither is good for the economy.
And yet, look at energy and defense. Oil prices are rising because tariffs create uncertainty in global supply chains. Defense contractors like Lockheed Martin and Northrop Grumman are seeing new highs as Washington increases military spending in response to global instability. This is about strategic realignment.
That's the keyword, instability. The tariffs are creating a ripple effect through supply chains. U.S. automakers rely on Mexican parts, American retailers depend on Chinese electronics, and tariffs disrupt those relationships. It's not just about higher costs, it's about structural inefficiencies. The companies that thrive under tariffs aren't necessarily creating more value, they're just benefiting from government intervention.
Or they're benefiting from a long overdue correction. We've been overly dependent on low-cost foreign labor and cheap materials for too long. If these tariffs force companies to rebuild domestic supply chains, we could be looking at a manufacturing resurgence in America.
And how long will that take? Years? Decades? And in the meantime, what happens to workers in industries that are hit first? If car prices rise, demand falls. If tech companies cut margins, jobs get cut. If retailers pass costs onto customers, spending slows. The average consumer isn't playing the long game, Max. They're trying to survive right now.
And what happens if these companies stop outsourcing? What happens if factories reopen in Michigan instead of Shenzhen? This could be the moment where America reshapes its economy, bringing back industries that were written off as lost. Tariffs aren't just about trade, they're about economic independence.
Or they're about economic isolation. The companies being hit hardest, tech, autos, and retail, are the ones that power consumer spending, innovation, and economic growth. If this trade war keeps escalating, it's not just about who wins today. It's about whether the economy is positioned to win tomorrow. And right now, that's still an open question.
Then let's answer it. Next up, how are global players reacting? Is this a U.S. power move, or is the world moving on without us? Tariffs aren't just a U.S. policy decision anymore. The world is striking back. This isn't just a trade negotiation. It's a global economic war. Countries are responding fast, recalibrating alliances, and in some cases, fighting fire with fire. The question is, who comes out on top?
Max, the retaliation has already started. China just announced counter tariffs on key U.S. exports. Soybeans, aircraft parts, and semiconductors are now targets of a new 15% tariff. That means U.S. farmers, aerospace manufacturers, and chip makers are taking direct hits. The U.S. may have fired the first shot, but global markets are now in the crosshairs.
And they're not alone. Mexico just rolled out its own counter tariffs on U.S. steel and agricultural goods. Canada is taxing U.S. dairy and wine. The European Union, they're looking at luxury goods, auto imports, and even tech. This is a full-scale economic confrontation.
And let's not forget the BRICS nations. Russia, India, and Brazil aren't just watching, they're taking action. China and Russia have already started shifting trade away from the US dollar. They're settling oil transactions in yuan, increasing trade with BRICS partners, and expanding digital payment systems that bypass Western financial networks. India, meanwhile, has boosted commodity imports from Brazil and Russia to reduce reliance on US and European suppliers. If this trend accelerates, we're not just looking at a trade war. We could be witnessing the beginning of a permanent global realignment.
That's a stretch. The dollar is still the world's reserve currency. The U.S. economy is too big, too embedded, and too powerful to be replaced overnight. And let's be honest, China, Mexico, and the EU still rely on American consumers. Retaliation is expected, but they can't afford to cut off the U.S. entirely.
They don't have to cut the US off entirely. They just need to diversify enough to reduce dependence. Look at China. They're increasing imports from Brazil, Russia, and Southeast Asia. India is expanding trade deals in Asia and the Middle East. These shifts don't happen overnight, but the more the U.S. pressures its trade partners, the more incentive they have to find alternatives.
Sophia, this isn't the first trade war in history. The U.S. has played this game before, and guess what? It still came out on top. Washington is forcing its trading partners to renegotiate on America's terms. Countries might retaliate, but they still need access to U.S. markets. And that leverage is what will force them back to the table.
That assumes other nations are willing to play by the old rules. What if this is the moment the global economy realigns? What if countries decide that they'd rather shift trade away from the US entirely? We're already seeing early signs of that. This isn't just about tariffs, it's about long-term economic power shifts.
That's speculation. The immediate impact is what matters right now. Markets are reacting fast. Hedge funds are shorting vulnerable industries. Major corporations are delaying capital investment, and investors are shifting capital into commodities and defense stocks. Money moves faster than trade policies, and right now, the smart money is hedging.
And there's another problem: domestic backlash. Washington isn't united on this. Major corporations and state governments are pushing back, warning that tariffs could cost American jobs. We've already seen lobbying from automakers, tech companies, and retailers demanding that tariffs be rolled back or adjusted. And let's not forget Congress. Not everyone is on board with Trump's aggressive trade stance. If political pressure mounts, will the U.S. be forced to step back?
So you're saying this could permanently change global trade? That's a bold take.
I'm saying that if the U.S. keeps pushing, the world will find ways to push back. And if that happens, this isn't just a trade war, it's a restructuring of global economic alliances. The question is, does the U.S. gain more than it loses?
And that's what we're breaking down next. How far can this go before markets, corporations, and governments start looking for an exit strategy? Every trade war has a breaking point. The question is, how close are we to reaching it? Tariffs are supposed to be a negotiation tactic, short-term pain for long-term gain. But when do the consequences outweigh the benefits? Are we headed for a full-scale economic slowdown?
Max, we're already seeing real signs of strain. Inflation is rising, consumer spending is under pressure, and companies are starting to slash forecasts. Economists are warning that if this escalates further, we could see a slowdown in U.S. growth and even a global recession.
Let's break this down. First, the markets. Volatility is spiking, VIX is above 23, and investors are rotating into safe haven assets like gold and treasuries. But here's the bigger question. If inflation spikes in the next 6 months, will the Fed be forced to hold rates higher for longer? And if supply chains aren't realigned by Q3, we could see major earnings slashes in tech and auto, layoffs in consumer sectors, and a deeper market correction. This isn't just volatility, it's a stress test for the entire economy.
The numbers don't lie. Retail giants like Walmart and Target are already warning about price hikes across the board. Tariffs mean higher input costs, which get passed to consumers, and the longer they stay, the worse inflation gets. The Fed is now in a policy trap. If inflation spikes within the next 3 to 6 months, they can't cut rates without risking another inflation surge. But if the economy contracts too quickly, corporate layoffs could start hitting by Q4, and we could see a slowdown that's impossible to reverse. This isn't just a trade war. It's a macroeconomic balancing act with no easy way out.
And yet the White House insists this is a necessary transition. The argument is simple: short-term disruption to rebuild U.S. industry and manufacturing. If tariffs push companies to reshore production, the economy could be stronger in the long run. But Sophia, you're saying the short-term damage could be too much.
Exactly. Look at historical precedent. The Smoot-Hawley Tariff Act of 1930 turned a stock market crash into a global economic collapse. More recently, the 2018 to 2019 trade war between the US and China cost billions in lost trade and led to supply chain shocks that still impact us today. If companies cut jobs or delay expansion because of tariffs, the damage becomes structural. That's when you get a real crisis.
But let's be real. Some sectors are benefiting. Defense stocks, steel manufacturers, and domestic energy companies are booming. The US dollar is strong, and some investors see this as an opportunity. What if this is just a correction, a rebalancing that ultimately makes the economy more resilient?
That's possible, but it's risky. The real breaking point isn't just stock market volatility. It's what happens when businesses, consumers, and policymakers start looking for an exit. If companies' investment, if inflation forces the Fed's hand, and if global trade flows shift permanently, then the breaking point isn't a matter of if, but when.
So, what's the timeline? How long before we know if this is just turbulence or something worse?
That's what we'll tackle next. How long does it take before markets, corporations, and policymakers start demanding a way out? And if that happens, what does an off-ramp from the trade war even look like?
Trade wars don't last forever. At some point, both sides need an exit. The U.S. isn't looking for a permanent standoff. This is about using leverage to force better trade deals. The question is, what does a realistic off-ramp look like? Are we weeks away from a resolution, or is this just the beginning of a long and painful trade battle?
That depends on how deep the damage goes. If the goal is to pressure trade partners into new deals, then a resolution could happen quickly. But if tariffs start weakening economic fundamentals, slowing growth, increasing inflation, and eroding corporate confidence, then reversing course becomes much harder. Governments don't want to look weak, especially in an election cycle.
And yet, history shows that tariffs can work if they're used correctly. Reagan used tariffs in the 1980s to force Japan into a better trade agreement. Even Trump's 2018 tariffs on China led to a Phase 1 deal. If the strategy is to pressure China, Mexico, and Canada into renegotiation, then pulling back tariffs in exchange for concessions is the logical outcome.
Except global trade is a different game now. China isn't the same China as in 2018. Back then, they still depended heavily on US markets. Now, they've built trade relationships with BRICS nations, shifted to internal consumption, and are reducing reliance on the dollar. If the US keeps pushing tariffs, China might decide it doesn't need a deal. It might just wait out the political cycle.
Then let's talk about Europe. The EU doesn't want a trade war, but they also can't be seen as weak. They'll push back with counter tariffs, but they prefer negotiation. A potential off-ramp could involve a temporary tariff truce. Both sides agree to freeze new tariffs while negotiating structural changes.
That's assuming political leaders are willing to de-escalate. Right now, every country has domestic pressures keeping them from backing down. The US is in an election cycle. China's leadership doesn't want to look weak. Europe is dealing with internal economic challenges. If no one wants to be the first to blink, this could drag out for years.
So you're saying there's no way out?
I'm saying that without a clear economic incentive for de-escalation. Trade wars have a habit of becoming permanent. If businesses start adapting, shifting supply chains, finding new markets, and assuming tariffs are here to stay, then even if leaders want an exit, it may be too late.
Then that's the big question. Are we on a short-term path to a deal, or is this a new normal? If the US doesn't strike a deal soon, do we just accept that tariffs are the future of global trade?
That's exactly what we're diving into next. Are tariffs just a negotiating tactic, or is the world fundamentally changing? Because if tariffs become permanent, this isn't just a trade war, it's a whole new global economic order.
We've seen trade wars before. They start, escalate, and then countries cut deals and move on. But this time, it feels different. What if tariffs aren't just a temporary policy? What if they're here to stay? Are we watching the birth of a new global economic order?
I hate to say it, Max, but you might be right. Historically, tariffs have been a means to an end, a tool to force better trade agreements. But now, more countries are shifting toward protectionism. The EU is talking about permanent trade barriers against the US. China is ramping up self-sufficiency, and BRICS nations are moving away from the dollar.
That's because the old free trade model is broken. For decades, globalization meant cheap goods, open markets, and multinational supply chains. But COVID, supply chain crises, and now tariffs have exposed how fragile that system really was. Countries are realizing they can't rely on each other the way they used to.
And companies are realizing that too. Look at Apple, Tesla, Ford. They're all diversifying supply chains. Some are shifting from China to India, Mexico, or Southeast Asia. Others are bringing production back to the US, but at a much higher cost.
Look, Sophia, companies aren't just sitting around waiting to bleed profits. They know the game. If they don't want to pay 25% more on imports, they'll either move production to friendlier countries or bring it home. It's economic Darwinism in action. Adapt or get left behind.
Sure, Max, if by economic Darwinism you mean consumers paying 25% more for the same product, maybe survival of the fittest sounds great when you're on the corporate side, but tell that to the families who can't afford their next car because of tariff-driven price hikes. This isn't innovation. It's inflation with a fancy label.
Or maybe we just adjust. Look at the US economy. It's resilient. Companies will innovate. Consumers will adapt. Maybe globalization wasn't the solution we thought it was. Maybe a world with more economic independence is actually stronger in the long run.
Or maybe we're entering a period of permanent economic fragmentation. If tariffs stay in place long-term, global trade agreements break down, supply chains shrink, and the cost of doing business everywhere goes up. If this is the new normal, the whole world gets poorer.
Then the real question is, who benefits from this shift? If tariffs are the new normal, is the US truly gaining long-term strength, or are we walking into another economic trap? Will American industries reap the rewards of protectionism, or will global trade realign in ways that leave us weaker than before? These aren't just policy questions, they define the future of global economics. And we're going to break it all down next. If you want to stay ahead of the biggest financial trends, don't just listen, stay engaged. Subscribe now on Apple Podcasts, Spotify, and follow us on Twitter. Dive deeper with our full lineup: Finance Frontier, AI Frontier, Make Money, and Mindset Frontier, all curated in one place at financefrontieri.com. And if you're already with us, help grow the community by leaving a 5-star review on Apple Podcasts or Spotify. It's the best way to support the show and bring this knowledge to more listeners like you. Don't miss out. Sign up for our newsletter to get exclusive insights, breaking financial news, and expert analysis delivered straight to your inbox.
Before we go, remember that the information shared in this podcast is for educational and informational purposes only. It should not be considered financial advice. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions.
Mergers, acquisitions, and geopolitical shifts carry significant risks. Political uncertainty, economic instability, and regulatory changes can impact markets in unexpected ways. Always analyze the broader implications before making any major financial decisions.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier AI Copyright 2025. Unauthorized reproduction or distribution is prohibited.